Let us continue on with our wrap the week. This is our weekly effort to try to make sense of how things have evolved. I know at times when we've wrapped the week, it's been a little easier of sorts because it's sort of an update from the previous week. But now I think we're at one of those inflection points where things are fluctuating. And if you've picked up on my tone going from less optimistic to more pessimistic, and that's maybe not the right way to do it, less constructive about long-term upside and more cautionary about limited upside. That's certainly, I think, what the charts were reflecting this week. I wanted to start off, though. We asked a poll because, again, in any environment, there are always outperformers and underperformers. And I think if you think like that, which is how a money manager would think about this environment, where could you be defensively in the case of downside? It's an important process to go about. We asked all of you, what struggling sector do you think will perform the best over the next 3 months? And we gave you 4 choices: financials, energy, industrials, and utilities. And 3 of those, financials, energy, industrials, these are ones that came on strong a couple weeks ago, right? Those are the beaten down kind of value-y sectors that all just ripped to the upside, with banks looking good, defense sectors, airlines, energy names across the board, just erupting to the upside. And then they've sort of come back to earth in the last couple weeks, sort of settling back down as the growth trade again reemerged. Big cap tech, consumer, and elsewhere sort of emerged again as the leadership. The answers were: number 1, industrials with 37% of you. Second, sort of a tie between energy and utilities, both around 22-23%. And then a financials, 4th place and 19%. A couple things strike me here. Number 1, no clear winner, although industrials certainly had the most votes. There wasn't a standout, a standout winner across the board here. Industrial sort of won the popularity contest, but no majority from the results here. Interesting, as banks have sort of sold off, and today financials really leading the way lower, right behind communication services. Energy also down big today. Industrials was actually down just a little bit, almost 2%. Utilities was actually the best performing sector today. So interesting to see. Very few of you actually picked utilities, and today on a big down day in equities, utilities actually the top performing sector. I asked about a 3-month window, though, and I think that's what the question really gets to. So my purpose of asking that question, what I would hope you do as we go through our process of wrapping the week, we think about some of the sector rotations, and also on Monday when we dig particularly into sectors, is think about some of these sectors that may have been off your radar, and make sure that you don't lose sight of all 11 sectors. There are opportunities out there, and don't get caught off guard with a sector emerging and getting it done on a relative basis, and you're not aware of it. Let's continue this wrap the week. Just as a quick update on what happened today, the S&P finished down, and that really finished down toward the lows, going back below 3010 and closing just above 3009. That's down 2.4% from Thursday's close, where we rallied and really strengthened into the close. Mid caps down a little less, small caps down a little more. So this was not a clear small, then mid, then large, which is some of the pattern we've had recently. This is small caps leading the way lower, but mid caps actually a little less. The VIX back up to just above 34 today. Talking about the other markets, and then we'll continue our wrap session here. The TLT, the bond, long bond ETF, up 1% to 165. We talked in the last couple of days. Yesterday we had a fixed income focus in the show where we talked about the TLT rotating higher, talked about the importance of hitting above the 50-day moving average, hitting above the recent swing high. This is after it broke above trendline resistance. That follow-through certainly happened today. So I think bond prices certainly pointing to further upside going into next week. On the commodity side, gold finished higher. It actually opened up a lot lower today, but then by the close had sort of round-tripped and gone back to the positive side, with the GLD around 166.50. That's up 0.4% from yesterday, and oil down 2%. Energy, again, one of the worst sectors today, and that's sort of part of that. Let's continue sort of this. Sorry, I'm jumping around just a little bit. We'll focus here on the daily chart of the S&P. We'll do our weekly review from there. So some of the things we talked about looking at the S&P 500 is sort of this pattern of higher highs, higher lows, or lower lows and lower highs. And I say those phrases so often. My wife makes fun of me often for doing it, but I've often found that it's those simple comparisons that we don't do that a lot of times will keep us out of trouble. So for me, what's the pattern that I'm seeing? I think we've now established a lower high around 3150 that seemed apparent earlier in the week. And I think, Tuesday's session as we traded higher and once again closed down, it really solidified 3150 as sort of the short-term ceiling, the tactical resistance in the market here. We've now today closed below the 200-day moving average, on par to close below the swing low from the second week in June. I think that break below there would confirm a lower low, which would be a lower high, a lower low. We're now in a downtrend. We're not there yet, which means we're right at that point where you'd expect support. And so I think going into next week, a holiday week, which usually tends to finish stronger rather than weaker. If you look at the average holiday week, tends to be a little lighter volume, especially going into Thursday's session. But we'll see if we get the bounce or not. We've now closed through the 200 days. So first things first, do we get a follow through today on Monday? Do we get further downside, or do we get a bounce back, sort of, seeing that the market has established support? So the lowest close that we've seen was right around here, right at the 3,000 level, and that's the level I'd be looking for. It's almost the lowest point today. That's what I'd be looking for on Monday. Interesting to note that the daily RSI has now gone below 50, and we talked about that this week as being, an indication of a change of feel, right? The market, or the S&P, had been above the 50 line for the last 3 months or so. Breaking back below would certainly signal a change of configuration of sorts, and I think we got that today for sure. So at the very least, we are in consolidation mode, which I think we've been for a while. Now I think you need to be eyeing short-term support, identify some levels, not just on the market, but for the market, and not just for the market, but for individual names, to identify what we're seeing. Just as a quick check on how things have changed week to week, here we are. This is looking at the last 5 days, and I sort of update this going into the close. So the numbers might be a little off from where we finally closed, but the S&P is certainly down and was the worst of the major ETFs that we would follow. The TLT finishing higher, but gold was really the biggest winner, going up 2% over the last week. Commodities essentially flat for the week, and the oil in the form of the USO flat as well, essentially. So this was definitely a rotation away from stocks into bonds and into gold, which was the number one performer out of the three. Let's look at cap tiers. So what we'll do is we're using the perf chart here. You right click, say past week. We're going to look at just the bars, which make it pretty easy to pick out. I'm going to normalize all this to the S&P 500, which is down about 1%. You can see mid caps underperformed by another further percent. So they were down over 2% this week. Small caps were sort of in line with the large cap index, but you can see micro caps had outperformed. But look at all the non-US markets. EFA up 1% relative, emerging markets up 2% relative, frontier markets up 2% relative. So we've talked about the weakness in the dollar, this rotation away from the US into non-US markets. And this week certainly continued that pattern of rotating from the US to non-US. And as a reminder, not that you need to go all in on non-US stocks, but if you're completely naked those, if you don't have any exposure there, maybe worth just seeing if there's some opportunities. Finally, we'll normalize the 11 S&P sectors to the S&P. That is now flat for the week. We're looking at relative movements. So the big losers, the underperformers this week, were utilities, which were down 4% relative to the S&P. Energy almost down 4% as well. The next tier after that were industrials and real estate, both down over 2% for the week. The only two sectors that were up on the week relative to the S&P, technology up almost 2%, healthcare up 1/3%. The rest are sort of flat to down, just a rounding error or so. So, we've talked about the relative performance of technology, and in a down tape where I would expect people rotating to the relative safety of big cap tech. This week certainly felt the effects of that, with the relative strength of the XLK continuing higher. Healthcare actually notable for being number 2 out of the 11 sectors so far this week. I wanted to divert just very quickly, and I feel like I'm jumping around a lot, but I'll hopefully keep you along this ride with me. We talked over the last week or two, I think it was 2 weeks ago, I came up with these 3 stocks. It was Applied Materials, Morgan Stanley, Starbucks. And I said, if you watch those 3 stocks, I think you'll get a good read on the overall market. My weekly review on last Sunday, going into Monday's show, I added 3 more stocks to that list of names that I thought were actually pretty meaningful to watch: Cisco, Nike, and Disney. And I'm grouping these 6 together, calling them the Mindful 6. I created this chart just to very quickly show you where they're at, and I would ask you to focus on where they're all at relative to their moving average and relative to the recent swing low, which is indicated by this horizontal pink line. So here's the S&P testing its 200-day. The swing low is just a little further below us, around 29.50. Stock number one is Applied Materials, maybe the strongest of the six, holding around 59. It would have to get below 55 to get below the swing low and also the 200-day. So that's a key level to watch for Applied Materials. Looking at Morgan Stanley, so it's the only financial stock in here. We now have established a lower low similar to the market. 45 is really the line in sand, the 200-day as well as the swing low. Starbucks is the first stock to be testing this new low. I actually tested it today, already below the 200-day, but testing support. So you want to see if we get a follow through. But this is the first one on our list that's actually tested that swing low. So 1 out of 3 now testing support. Cisco holding up okay, and you want to look below 44 for support. I would say Nike is the second one, sort of getting very near to its support around 92.50, and Disney is now our second stock, which is broken lower. So 2 out of the 6, testing that key support level. I would say Disney the first that's actually confirmed a breakdown with today's sell-off going due. So 5 out of the 6 still remaining above support, 1 out of the 6 still testing it. And that's the list I'll keep looking at in the coming weeks. Again, if these stocks are all able to relatively, for the most part, hold those support levels, I think the market's gonna resist, further dramatic downside. But as these one-on-one break down, I think I'll get more and more, less and less constructive about the prospects for what's coming up next. We're going to finish off looking at the Mindful Investor Live chart list. As a reminder, there's just a series of charts that I look at every week to understand the macro picture. We'll look at this again on Monday as part of our macro overview. The long-term trend following model that I have is actually positive. Turned positive a couple weeks ago. The tactical read, which is looking at the week-to-week change in the weekly PPO, actually turned negative this week. So now we're tactical negative, medium-term, long-term still bullish according to that measurement, which feels about right based on what I've seen. We've already talked about the daily S&P chart. So let's go to the look on breadth. Now, this chart is not updated for the close yet because our breadth indicators lock in after the close, after we digest all those changes. But I would not be surprised if many of these, if not all of them, break to a new swing low. I'm looking at that swing low in the cumulative advanced decline lines, all 4 of them very near, with mid caps maybe testing them the most. I wouldn't be surprised if these all actually go below their swing low from a couple weeks ago, which means I will color code them red and suggest that the breadth has turned negative. I think it's pretty close to signaling that. Just 1 or 2 more charts to look at here, and then we need to take a break. The next one is looking at the percent of stocks above their 200-day, the percent of stocks above their 50-day. Still 64% of the S&P names above their 50-day moving average. The problem is that's down from over 95% just a week or 2 ago, which means 30% of S&P names have now rotated back below their 50-day, which is a pretty significant swing. We talked about the 50% line being a key one for the percent of stocks above their 200-day. We are below that, around 38% going into today's close. I think we're going to go further down as some stocks broke below their 200-day moving average. So overall, the breadth picture has gone from bullish to neutral, and now I'm starting to see neutral to more bearish. Finally, just to finish off, I think the sentiment in the form of the AAII ratings continuing to be relatively negative. It's almost a 50% spread again between the bulls and the bears, favoring the bears, which means it's double the number of respondents saying bearish versus bullish. So the sentiment has certainly swung from sort of an even keel about 2 weeks ago to certainly leaning more on the bearish side.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.